Here we are on our last chapter, chapter 12, and I wanted to add, although you see 2013 on the bottom of these PowerPoints, these are 2021. They really haven't changed that much in the book over the last 8 years. So I'm using PowerPoints, all my different PowerPoints to do these presentations. So I just want you to know that these are new. All right, so now we're going to look at what do you do when you're thinking about making an investment, i.e. a capital investment. You're going to do something like acquire an asset. An example would be equipment, a facility or plant, a vehicle, or software. Well, you want to look at this in terms of if you invest in it, how are you going to benefit? And we have various ways of looking at it. One of them is called Payback. This is a quick and easy method to do it. It's fast, and remember, it's for short lifespan investments. Or we can use the accounting rate of return, which is also for short-term investments, indicates profitability of investment. Or we can use net present value, factors in net present value, better for longer lifespans. And we can use the internal rate of return, which factors in net present value, better for longer-term projects. Now, these focus on cash flow. Capital budgeting focuses on the cash flow. Desirability depends on the net cash inflows. You want to look at what am I going to spend versus what am I going to get back, and you're always trying to look at it in today's dollars. Now, only the accounting rate of return takes into consideration accrual accounting, cash inflows, future cash revenue from the investment, and future savings and ongoing cash operations. That's what we're going to look at. And we're going to compare that to what we're going to spend. And we also want to look, is there any residual value? So we're going to look at all these things and compare them to the investment to see, is this a good decision? Net cash inflows against cash outflows from investment, that's important. But we're going to look at two methods in part one. First method we're going to look at is payback. Now payback, this is a real easy one to do. It shows the length of time to recover in net cash inflows the cost of the capital outlay. Measures how quickly managers expect to recover investment dollars. Shorter payback period is the most attractive. So we're going to take the amount invested divided by the expected annual net cash inflows. So our decision is investment with the shortest payback are more desirable because why? Because it's more easy to predict in the short term than it is, say, 10 years from now versus 2 years from now. So let's look at this example. They want to do an expansion, and what it's going to do is they're assuming that they'll have an additional 118 skiers per day. They'll have an average number of ski days of 164. The useful life of the expansion is 10 years. The average cash spent by skiers each day is $238, and the variable cost to servicing these skiers is $134 a day, and the cost of the expansion is $9,500,000, and our discount rate is 12%. Also, we want to assume straight line depreciation, and it has a residual value of $700,000 at the end of 10 years. So first we're going to look at payback. So we just need the amount invested divided by the expected annual net cash flows. So in this example, we're going to get our money back in a little under 5 years. Is that good or bad? It depends what we're comparing it to. Now, the advantages of this method, again, is it's simple and it highlights risks, i.e., how long does it take to get your money back? The disadvantage is it ignores cash flows after the payback period, and it ignores the time value of money. Time value of money is $1 today is worth more than $1 in the future because of interest. Now, let's look at the accounting rate of return. We're going to take the average annual operating income from assets divided by the initial investment. This measures the average annual rate of return over the asset's life, focuses on the operating income, not the net cash flow. Based on accrual accounting, must subtract non-cash expenses from the net cash inflows to arrive at the operating income. So we're going to take the average annual net cash inflow minus the annual non-cash expense, would be depreciation, divided by the initial investment. So here's our decision. If the expected accounting rate of return exceeds the required rate of return, we're going to invest. If it doesn't, we're not going to do that. So we're going to look at the same example, and we're going to compute our accounting rate of return. So first, we have to determine annual depreciation. Second, we have to determine net cash flow from sales. Okay, so in order to get the net cash flows, we're going to take 118. We're going to first take the amount of cash we're going to receive minus the variable cost per skier. We're going to take that times 118 skiers per day times 184 ski days, and we get $2,012,608 per year. Now we're going to take that average cash flow minus the depreciation divided by the initial investment, and it says our rate of return is 11.92. I'm rounding, that would give you 12%, so this wouldn't be borderline. Now, this is the only method that uses accrual accounting. Its advantages are it shows how investment will affect operating income and measures profitability of the asset over its entire life. Disadvantages, again, it ignores the time value of money. Now we can go to part 2 for chapter